Hi everyone, welcome to Madhuram Investment. Myself Ramesh Sahu, and today we are going to talk about very important ratio in a stock market, PE ratio, that is price to earning ratio. And we will also see a PE ratio of a Nifty, which is used by many investors to decide when to enter and when to exit the market. So to know this secret, please watch this video till the end. And if you haven't subscribed to this channel, please subscribe and press bell. So let's learn, earn, and enjoy. Price to earning ratio. So as you can see, price to earning ratio is calculated by dividing the stock price by the earning per share. So stock price you will get it from the stock market, current stock market, and how earning per share is calculated that we have seen in our previous session. So if you haven't watched, please watch. I will mention the link of the previous session in the description box. Let me explain you with the example. So here the stock price is 200 and the EPS is 20. So when I divide 200 by 20, my PE ratio comes to 10. So what did it mean by 10? 10 means you are paying 10 times of the earning of a company to buy this share. So what does it mean? So let me tell you in a very common language. Let's say if a company is earning 1 rupee, you are paying 10 rupee to buy the share of that company. There are different ways in which we can analyze a valuation of a company with the help of PE ratio. So let's see what are those ways. When you want to evaluate a company, you should see at least 3 years PE ratio to know how company is growing. Let's take the first example. In this example, the first year share price is 100 and second year is 110 and third year is 120. So that means company is growing consistently, but the growth is very low. That is like companies growing 10% every year. So this normally happens in the metal industry where the companies grow consistently, but their growth remains slow. In the second example, as you can see, the company's growth is very high and the company's earning is also like getting double every year. So that's why people are ready to pay higher P P for this because they are expecting this company to grow in a similar way in the future also. That's why they are ready to pay higher. In the third example, as you can see, the company is actually not growing. Their growth is getting declined. They're giving negative growth. So, and at the same time, their earning is also getting reduced. I mean, their earning is also getting negative, and that's why people are not ready to pay for it. And that's why the PE ratio for this company is getting declined year on year. Let's take the fourth example. In this, as you can see, from 100 to 500, in the second year it had grown almost 400%, and at the same time their like earning also grown like 150%, and people were ready to pay high P's. But in third year they had a very sharp correction. Their earning declined very sharply. The share price declined. At this same time, people are now not ready to pay that much PE for the same. So this normally happens in real estate companies where like in the second year they sold a lot of inventory, so their balance sheet is showing good numbers. But in third year the inventories are unsold, so now it is not shown in their balance sheet. So that's why they had a decline in this. So these are the different ways in which you can analyze the PE and decide whether to invest or not in that company. Now let's talk about the most important topic of the day, that is Nifty PE ratio. To explain you this in a better way, I have 20 years of Nifty PE ratio so that you can understand it better. See how what Nifty PE ratio decides. Nifty PE ratio actually decides whether the market is expensive or market is undervalued or cheap. So let's see how it decides. See, Nifty P ratio is what a lot of people say is 20, above 20 is expensive and below 18 is cheap. So you can see whenever Nifty P ratio goes up above 22, it gets the sharp corrections. When I'm saying sharp corrections, that means when you see Nifty declined, Nifty dropped 500 points in a day. So these are the sharp corrections, or 1000 points in a day. These are the sharp corrections that you can see, and it happens consistently every year. You can see about 22 it will give you a very sharp correction. Whenever it goes about 22 it will give you a sharp corrections, and whenever it goes below 18 then from there market starts like bounce back, and then again it will people start buying. And this is the strategy used by many investors. What they do is, normally when Nifty goes below 18 or 16, they start investing money, they start buying good stock, because this is the time where you get a lot of stock on a very cheap price or undervalued. And then when it goes 20, about 22 23, they start booking their profit. So this is a strategy used by many investors to make a good amount of profit. So that's all from my side. If you like it, please comment below and share it with your friends. That's all. Thank you.